US household debt has surged past $18 trillion. Even the most credit-worthy borrowers are slipping. Meanwhile, speculators are pouring $3 trillion into AI data center booms, fueled by cheap debt. And on Wall Street, regional banks are quietly flagging bad loans and fraud exposures. These aren't separate cracks. They are the same structural faults that brought down the market in 1929, now upgraded, globalized, and magnified. The world never feels more dangerous than in the moments when everything seems perfectly safe. That's the part nobody ever sees coming. Crashes aren't born in chaos, they're born in comfort. They grow quietly in the places where people stop asking questions, where every warning is brushed off as fear-mongering, and where confidence turns into something far more fragile, illusion. That's where our story begins. If you zoom out far enough, 1929 and 2025 look like two sides of the same coin. Different technology, different clothes, different slang, but the same heartbeat. The same dangerous calm. The same belief that the future would keep delivering endlessly just because the past few years felt good. In both eras, the markets didn't just rise, they soared. The news called it growth, investors called it genius, people sitting at dinner tables called it the new normal, and just like that, the world convinced itself that nothing bad could happen. In 1929, the decade leading up to the crash was filled with a kind of excitement the world had never seen. Radios, automobiles, electrified cities, the future felt like it had arrived early. Stocks doubled, then doubled again, and people believed they were witnessing the start of a permanent boom. But behind the party lights, something else was forming. Cheap credit flooded the system. Margin debt exploded. Everyone, from factory workers to college kids, borrowed money to buy stocks they barely understood. The higher the market climbed, the more people believed nothing could bring it down. Now look at 2025. The tools changed, but the psychology didn't. Zero interest rates replaced cheap credit. Crypto replaced bucket shops. Cryptomania replaced railroad mania. People didn't gather in smoke-filled brokerage rooms anymore. They gathered in group chats and Discord servers, sharing screenshots of their guaranteed moonshots. Apps made investing feel like a game. Social media turned speculation into a sport. And just like in 1929, everyone believed they had become financial geniuses overnight. But the real danger wasn't in the speculation itself. It was in the silence. The calm before something breaks. In both eras, warnings were dismissed. In 1929, economists who said the market was overheated were laughed at. In 2025, people who mentioned debt, inflation, or bubbles were shrugged off as doom people. Everyone wanted the party to keep going. Yet, history has a habit of whispering before it screams. Margin debt in 1929 ballooned to record highs. In 2025, global debt crossed levels once thought impossible. In 1929, households believed rising prices meant growing wealth. In 2025, people confused inflated asset prices for real prosperity. In 1929, newspapers called the boom permanent. In 2025, analysts said the same thing using different words. Soft landing, new paradigm, technology-driven growth. But no matter the century, bubbles don't pop because people panic. They pop because people stop believing anything can go wrong. That's the echo stretching across 96 years, the sound of a world leaning too far into certainty, right before the floor gives way. And as we open this story, one truth becomes impossible to ignore. The biggest crashes always arrive wearing the calmest faces. History doesn't repeat itself perfectly, but it does rhyme. And the rhyme between 1929 and 2025 is getting too loud to ignore. The most dangerous kind of money is the kind that feels free. When interest rates fall low enough, borrowing doesn't feel like a risk. It feels like a cheat code. That's exactly what happened in the 1920s, and it's exactly what has happened a century later. Cheap money doesn't just change the economy, it rewires people's behavior. It turns caution into confidence, and confidence into something much more reckless. In the late 1920s, the Federal Reserve kept interest rates low to support growth. It sounded responsible, it felt smart, but it fueled a new kind of frenzy. Margin debt exploded because people realized they could borrow a tiny amount of money to control huge amounts of stock. And once the gains started rolling in, everyone convinced themselves they were witnessing a golden age of wealth creation. No one saw that all this wealth was built on loans, stacked on top of loans. Fast forward to the 2020s, and the same script played out, but bigger, louder, and with global Wi-Fi. After the 2008 crisis, the world entered a new financial experiment. Zero interest rates and quantitative easing that never seemed to end. Money became so cheap that companies borrowed billions just to buy their own stock. Investors borrowed to chase meme stocks. Venture capitalists threw cash at any idea with a logo. Even housing turned into a bidding war powered by almost free loans. This time, the illusion wasn't limited to Wall Street. It hit every phone in every country. SPACs turned into lottery tickets. Crypto became the new gold rush. People bragged about paper profits the same way people in 1929 bragged about their stock picks. The tools changed, but the psychology stayed identical. Everyone believed the boom would last forever because the money fueling it felt infinite. But infinite money is always an illusion. Cheap credit hides risks until the day it doesn't. And just like in 1929, the belief that we could borrow without consequences set the stage for a collapse no one wants to imagine, but everyone can feel coming. Debt is a staircase that's easy to climb up and almost impossible to climb back down. That's the quiet truth sitting underneath both 1929 and 2025. Most people never notice how high they've climbed until the steps start shaking beneath them. And when money gets too easy for too long, debt becomes the foundation of everything. Not productivity, not innovation, not real economic strength. Just borrowing stacked on borrowing, reaching for a sky that never stops moving. In 1929, margin debt was the spark. People borrowed $5 to control 50. It worked beautifully until it didn't. When stocks dipped even a little, the loans became unpayable. A tiny crack in the system created an avalanche. But back then, the damage was still contained to individuals and banks. Painful? Yes. Catastrophic? Yes. But the fire was at least confined to the financial world. In 2025, that fire doesn't stay in one room. It spreads across the entire house. Debt today isn't just a personal problem, it's a global operating system. Corporations borrow to survive. Governments borrow to function. Consumers borrow to live. Even central banks use debt as a tool. The staircase hasn't just grown taller, it's grown wider, heavier, and far more fragile. By the early 2020s, global debt crossed $300 trillion, something that would have sounded like science fiction in 1929. Entire nations now depend on cheap borrowing just to pay for basic services. Companies roll over old loans with new loans. Households survive on credit cards, car loans, and mortgages stretched to the limit. Everything that once rested on productivity now balances on interest rates. So when interest rates finally rose, the whole structure began to wobble. What margin debt was to 1929, global leverage is to 2025, only this time, there's no easy way down. You can't unwind decades of borrowing without shaking the tower itself. And every tremor makes one thing clearer. The higher you build on debt, the faster everything falls when gravity returns. The strange thing about financial booms is that they never end with a loud bang. They end with a small, almost forgettable moment, like someone quietly reaching over and turning down the volume at a party. That's exactly what happened in 1929. The music didn't stop because of a war or a disaster. It stopped because the Federal Reserve raised interest rates a little, then a little more, until a little became too much. Liquidity dried up. Borrowed money became expensive. And when people couldn't afford to keep the illusion going, they began selling. A few sold out of caution, then a few more, then everyone. What started as a whisper turned into the most famous crash in history. The chain reaction was simple. Higher rates made loans harder to roll over. That forced investors to dump their stocks to repay margin debt. Forced selling pushed prices down. Falling prices triggered more forced selling. It was a self-feeding spiral, one small shift becoming an unstoppable collapse. Now, fast forward 96 years, the same story played out again, only this time it happened faster, louder, and on a global scale. Between 2022 and 2025, central banks unleashed the fastest rate hikes in modern history. After years of near zero interest rates, the cost of borrowing didn't just rise, it shot straight up like a rocket. The money that once flowed freely through markets suddenly froze. Venture capital dried up almost overnight. Tech startups that spent years burning cash with no consequences suddenly couldn't raise a dollar. Regional banks cracked under the pressure of bond losses, housing markets stalled, governments faced higher interest bills than ever, inflation roared, then refused to leave. And underneath it all, global liquidity, the oxygen of the entire system, began to vanish. The pattern wasn't just similar to 1929. It was identical in structure, identical in timing, and identical in outcome, just amplified by scale, technology, and globalization. Back then, rising rates crushed margin loans. Today, rising rates crush everything. Governments, corporations, banks, households, and entire markets tied together by debt. In 1929, the music stopped in one country. In 2025, it stopped everywhere at once. And the silence that followed felt frighteningly familiar. Crashes rarely look like crashes at the beginning. They look like tiny cracks, little problems that experts insist are contained, temporary, or nothing to worry about. That's exactly how 1929 unfolded. Before the stock market collapsed, the first signs came from brokerages drowning in margin loans they couldn't unwind, and banks quietly panicking about losses they didn't want to admit. It wasn't one big explosion, it was a slow motion toppling of dominoes that everyone assumed were glued down. The same thing is happening in 2025, only the domino line is longer, heavier, and connected to almost every part of modern life. The first cracks didn't show up in the stock market, they showed up in places most people don't watch. Office towers in major cities turned into empty glass shells as remote work refused to fade. Commercial real estate values didn't just dip, they collapsed. Landlords who borrowed heavily during the zero-rate era suddenly found themselves underwater. Buildings worth $300 million in 2019 were barely selling for half that by 2025. Then came the zombie companies, businesses that survived for years only because borrowing was cheap. Once interest rates climbed, their entire model fell apart. One by one, they filed for bankruptcy, leaving behind unpaid debts, laid off workers, and investors wondering how they had missed the warning signs. But the most silent dominoes were the ones people trusted the most. Pension funds started cracking under the weight of unfunded promises. Student loan payments returning after years of pauses pushed millions into financial strain. Credit card delinquencies hit levels not seen since the Great Recession. And in the background, regional banks already weakened by bond losses from rising rates began to fail in eerie echoes of the small-town bank collapses of the 1932nd. It's the same rhythm across a century. Small failures, ignored warnings, and a spreading sense that something is slipping out of control. In 1929, the first domino fell in a brokerage office. In 2025, it's falling in office buildings, households, pensions, and banks all at once. And the line is starting to shake in a way that tells you the biggest domino hasn't fallen yet, but it's already leaning. Panics don't begin with crowds screaming on trading floors. They begin with whispers, tiny, uncomfortable signals that something isn't right. In 1929, the panic started long before the crash that made headlines. Insiders were already slipping out the side door. Executives quietly sold shares. Wealthy investors pulled money from risky positions. Banks tightened credit to their favorite clients. All of this happened while the public was still celebrating record highs, convinced they were living through the greatest boom in history. The panic wasn't visible yet, but it had already begun. The same shadowed behavior is happening in 2025. On the surface, stock indexes still show strength. Headlines talk about resilience, soft landings, and consumer confidence. But underneath, the people who actually move the markets are acting very differently. Hedge funds have been de-risking for months. Major institutions are dumping long-dated treasuries, even at losses. Banks are hoarding liquidity like they expect a storm. Corporations are quietly freezing, hiring, and delaying projects. None of this screams crash, but all of it whispers, something's wrong. This is the part most people never see. A crash is never really about money. It's about confidence. When people believe the system is strong, it stays strong. When they start doubting, even silently, the entire structure starts to shake. In 1929, the public's confidence lasted right up until the day they realized insiders had already left. That's when panic erupted. Not because the numbers changed, but because belief collapsed. In 2025, the same psychological shift is brewing. Retail investors think rising stock prices means safety. But insiders know that rising prices don't matter when the liquidity behind them is drying up. Banks are preparing for a winter while the public still thinks it's summer. It's the confidence gap, one group seeing reality, the other seeing a mirage. History shows that crashes don't happen when things look bad. Crashes happen when reality finally catches up to optimism. When the crowd realizes the people they trusted to stay at the party left hours ago. And once that spark hits the dry ground of modern markets, panic spreads faster than any chart can show. Every crash in history has the same haunting rhythm. Years of rising confidence, months of quiet warnings, and then one spark that lights everything on fire. In 1929, that spark came from margin calls. As stocks slipped, brokers demanded cash that investors didn't have. Loans were recalled, liquidity vanished. What should have been a small correction turned into a historic collapse because the system was already brittle. A tiny flame hit a mountain of dry timber. In 2025, the timber is stacked even higher, and the sparks are everywhere. The modern world isn't waiting for one dramatic event. It's surrounded by pressure points, each one capable of triggering the same chain reaction that followed 1920's margin calls. And the scary part is that none of them look like traditional crisis triggers. They look like normal headlines until it's too late. The United States now spends more on interest payments for its debt than it does on national defense. That alone is a fault line. One political showdown, one failed budget negotiation, one missed vote in Congress, and suddenly the world's safest asset turns into the world's biggest question mark. Across the Pacific, Japan is fighting a currency crisis that refuses to calm down. A single sharp move in the yen could force its central bank to dump U.S. bonds, setting off a global chain reaction. China is wrestling with a property implosion so huge that entire cities sit half empty, while developers default in slow motion. Europe is still absorbing energy shocks that warped its economies long after the headlines disappeared. Any one of these would have been enough to cause tremors in the past. Here in 2025, they're all happening at the same time. That's the real danger. Fragility. The system has been stretched so thin, leveraged so deeply, and globalized so tightly that almost anything can trigger everything. A debt downgrade, a bank wobbling, a surprise inflation spike, a sudden bond market glitch. Each one is a spark looking for a fuse. And like 1929, the moment the spark lands, the system doesn't fail slowly. It fails instantly. Not because the world is ending, but because the world built itself on assumptions that no longer hold. The crash trigger isn't about what starts the fire, it's about how dry the world has become. We like to think the people living through 1929 were foolish, that they couldn't see the obvious, that they were caught up in hype and blinded by excitement. But the truth is far less comforting. They weren't stupid, they were human. They wanted the good times to last. They wanted to believe the future would keep rewarding them. They told themselves the same stories we tell ourselves today, that progress is permanent, that bubbles aren't bubbles, that warnings are just noise. They weren't wrong because they lacked information. They were wrong because they ignored it. And that is the part of history we never seem to learn. The setup of 2025 isn't fate. It wasn't written in some ancient book or locked into destiny. It came from decisions, thousands of them made by governments, banks, companies, and regular people who all chose the easy path over the honest one. We tolerated unlimited debt because it felt painless. We accepted cheap money because it made us rich on paper. We ignored risks because the charts kept going up. Just like in 1929, we traded reality for comfort, believing we could outrun consequences forever. But consequences always catch up. They don't come all at once, and they don't come fairly, but they come. Crashes aren't punishments, they're resets. They wipe away illusions so the world can rebuild on truth instead of fantasy. That's why every bubble in history ends the same way, with a shock that forces people to see what they never wanted to admit. So as this story closes, the message isn't about fear, it's about awareness. The patterns repeating today aren't warnings from the past, they're mirrors. They show us how easily confidence becomes denial, how quickly growth becomes greed, and how silently danger grows when nobody wants to face it. History doesn't repeat because the world forgets facts. It repeats because the world forgets humility. A crash isn't the end of an era. It's the price we pay for pretending reality doesn't matter. And if 2025 teaches us anything, it's that the bill always comes whether we're ready or not.